What's up, everybody? Tyler here, and I will be your host this evening. If you may or may not know, I am our head Forex trader for our fund, Vant Trading. And today I'm going to be talking about where we think the dollar will be heading in 2021 and what factors will be driving our analysis. So without further ado, let's first start off with what actually controls the dollar's value. Now, there's one big thing that really will control where the dollar goes and how it's valued, and that's supply and demand. Now, within supply and demand, there's about 6 different small factors that control, ultimately where supply and demand's headed. All right. Now, I'm going to be mentioning right now the 6 factors, but I'm not going to go too in depth right now because I will be having each factor as their own slide, diving into more depth. So first, we have interest rates. Second, we have inflation rates. Third is trade deficit. Fourth is foreign exchange reserves. Fifth is treasury notes. And sixth is risk appetite. Now, foreign exchange reserves and treasury notes, I won't be going into too in depth later on, so I'll cover them briefly right now. They aren't a huge driving factor for supply and demand, but they are there because things are starting to change a little bit. So there's more weight on interest rates and inflation rates and stuff like that. But you should really note those 2 things as well. Now, treasury notes, this really reflects how investors feel about the economy. Now, this is really a gauge market sentiment because if the economy is looking good, that means risk is on and traders are more willing to take riskier positions, which means the dollar will go lower because the dollar is a safe haven. And if it's a safe haven, it's really going to be invested in when risk is off and people are trying to keep their money safe. So treasury notes, if the demand is high for them, that means risk is off and investors are taking the safe route because the treasury notes are guaranteed and backed by the government. So it's a very safe investment. So if the demand for the treasury notes is high, that means the market sentiment is very weak and there's going to be a lot more demand for treasury notes. So that means the yield will be low during times of high demand. And on the flip side, if demand for treasury notes are low, that means risk is on and investors are looking for riskier trades and the economy is looking good, which means the dollar will weaken since it's a safe haven, right? So the dollar moves with the treasury notes, not the yields, the treasury notes, because the yields, if the treasury note demand is high, the yield will be low, right? Because that means that the government will drop the rate on which they give back to you because the demand is high. It's like a supply and demand, right? So keep an eye on that. And the second thing is foreign exchange reserves. Now, not many people know what this is, so I'll explain what it is real quick, all right? So it's the foreign currencies held by a country's central bank as reserve. For example, you have China, and they might hold the dollar in their reserves for 2 different reasons. The first one is to keep their currency, the yuan, at a lower value to increase exports since it'll be cheaper, right? So the reason that it'll make the value lower for the yuan is because if you're taking some dollar currency and holding it in your reserve, you're taking the dollar off the market, which decreases the supply of the dollar. And that also in return increases the demand and the value of the dollar will increase. Well, if the value of the dollar is increasing, then the yuan will be decreasing because it's a pair and the dollar will be increasing versus the yuan. So that's one way to keep their currency at a lower value to make it easier and cheaper for exports. And then the second reason is to maintain liquidity. Just for some freak nature accident or something where they can't use their currency and they can't use their central banks, they'll have the dollar in reserve they could use to pay for any imports they have or any other obligations they might have for their country. So those are the main reasons for foreign exchange reserves, but the reason it affects supply and demand is because the countries that hold the dollar in reserve will be taking dollars off the market and decreasing the supply. In return, will push the value up of the dollar and increase the demand. So that's treasury notes, that's foreign exchange reserves, but they aren't a huge role, especially because times are changing right now a little bit. So let's dive on more into what actually is really affecting the supply and demand right now. But first of all, our thesis for 2021 is that the dollar will drop around 15%. And there's many different reasons why we think that, and I'm going to be explaining them now throughout the course of the presentation. I'll be explaining first, what interest rates are, then inflation rates, and then risk appetite, trade deficit, and stuff like that. And then at the end, I'll be going into the technical analysis and comparing it to the stock market, comparing it to 2008, comparing it to Yellen, all that kind of stuff. So bear with me, hang in there, and I'm going to explain in depth why we think the dollar's poised for a big spiral down in 2021. Now, firstly, you have stimulus packages, and this might be the biggest reason we're seeing a drop in the dollar. Stimulus packages is really the big reason we're seeing supply and demand falter. Now, I'm going to be going into stimulus packages on the next slide more in depth, so I'm not going to be going into it right now. Right now, I'm listing all the factors next year, or I guess this year, that we should be looking at, and then I'm going to go more in depth. So you have stimulus packages, you have interest rates and inflation rates, you have risk appetite, you have international trade uncertainty, and lastly, you have the corporate tax bill. Now, all of these factors you see on the screen will be the driving determination on where the dollar will go with supply and demand. Okay, so moving on to first the stimulus packages. Now, you have this, Big Daddy Powell throwing money at the American people, right? So all we've been doing this year is printing money for quantitative easing, for stimulus packages. And I'm not saying it's a bad thing, but it's a good thing for the economy and the American people, but a very bad thing for the dollar, because what you're doing when you're printing the money, right, is you're increasing the supply of the dollar, and in return, that decreases the value. So now that's increasing supply, decreasing value, which will ultimately cause the dollar to go lower because supply is up, demand is low. And now that, with that, given that, the dollar value will move lower. And this is a big thing because right now, with this previous stimulus package that was passed December 27th, Biden called that a down payment for a future package. Now, if that's only a down payment, we're looking for more printing in February, which will really cause the dollar to go down because that's increasing the deficit and the government debt. And that's going to be a massive increase in supply and decrease in value. So this is one of the biggest things we're seeing this year that will cause the dollar to drop, is the massive increase in government debt. Now when we're talking about interest rates and inflation rates, this is probably up there, if not the most important, the second most important behind the stimulus packages. So, as you know, or as you may not know, the Fed came out and said they're keeping a near 0% interest rate through 2022. Now, one thing to know is that inflation will always reduce the value of money unless interest rates are higher than inflation. But that means interest rates need to be higher than inflation, right? Well, if interest rates are staying at a near 0% all next year, that's nearly impossible to have. So now we're heading into reflation, where we're going to have almost 0% interest rates and high inflation, and we're going to be reviving and pumping in the economy this year. That's going to cause high inflation, low interest rates. That really weakens the dollar. And let me tell you why, because there's an inverse relationship there. If interest rates are lower, 0%, and inflation rates are higher, 1.2%, that means there's a weak dollar, because that's not very enticing for foreign investors, which will cause a lack of demand. If foreign investors are going out there looking for value plays and ways to make money, they're going to look at the dollar and be like, 0% interest rate, 1% inflation, how am I supposed to make money in that? So it's not very enticing. It's going to cause a weakening in demands, and that will cause the dollar to drop. If interest rates on the flip side are higher, say 3%, and inflation rates are lower, say 1.5%, that's going to equal a stronger dollar. And the same thing, that will attract global investors and raise demand. If global investors are looking for a good value play, they're going to see the dollar has a 3% interest rate and inflation is 1.5%. That's good for them. They're going to make some money, so let's invest in the dollar. So that increases the demands. Now they have inverse relationships, so you got to keep that in mind. You got to always see, where it's at. But it's also somewhat in comparison to other countries, because if we see a 0% interest rate, but then like a 1% inflation, but you see other countries have like negative interest rates and like 5% inflation, the dollar does look pretty enticing, right? But that's really not something we're looking at right now. It's not something that's really in play. So one thing to note is that with the dollar at 0% and higher inflation, we're going to be kicking in a reflation. So that's going to be very tough to combat inflation when we're having 0% interest rates, because in order for banks to combat inflation, they raise interest rates, but that's not happening this year. So we're going to head into reflation, and that's going to cause the dollar to drop. So that's another big thing that we're looking at this year. Another very, very important concern that we're watching is the vaccine distribution. With vaccines for the COVID-19, as you know, in 2020, COVID-19 was the big driving factor of why the economy sank this past year and why the dollar is going to take a hit. Well, you have this very nervous citizen right here, this very nervous individual, right? And they're seeing that, wow, we have a vaccine for COVID-19, which was the main reason everybody panicked this past year and started freaking out. Well, if we have a vaccine for it now, that's going to be a very optimistic recovery down the line, right? Because if we're starting to see some kind of distribution and global vaccinations, that's going to give people hope and bring a positive outlook for 2021. And it's going to bring people out of the rabbit holes, because that means that now risk is on. People are ready to come back out and start investing again and start recovering the economy. Well, if risk is on, the dollar is a safe haven. So nobody's going to be investing in the dollar if they're trying to find riskier trades. So that means that we're going to see the dollar drop because we have an increase in vaccine distribution, bringing a positive consumer sentiment. Another reason that we'll probably see the dollar drop is because foreign investors will be looking for value plays. And I mentioned this in the last slide. With 0% interest rates and investors coming out looking for some value plays, they'll be investing in the emerging markets, the up and coming, not the dollar that's going to stay at 0% interest rate all this year. That's not happening. So that's going to be a very weak demand with a positive consumer sentiment like that. So that's another big thing to watch this year, is if we continue to see vaccine distributions and more confidence in that, that's going to be very good for the economy and weak for the dollar. International trade uncertainty. So right now, we have this deal where that, it's called the China trade wars that we've been going on, where Trump was trying to deal with the Chinese imports and exports. Well, under that deal, China must increase its purchasing of U.S. products and services by $200 billion over 2020 and 2021. Typically, that's good for the dollar, right? Because that's going to increase the demand, because if the China is purchasing U.S. goods, they have to exchange their yuan for dollars. And while they exchange that and pay with the dollars, that's going to increase the demand and strengthen the dollar. However, if Biden is not too keen on the tariffs that are set. Now, if Biden comes in and decides to reduce the tariffs set, then that could be good for the Chinese economy and their currency, which will cause it to rise against the dollar, leaving an unsettled greenback. So that's something to watch this year. How Biden did say he's not going to jump to conclusions or change anything right away. So you might not see this come into play. But if you do see Biden mentioning reduction of tariffs on China, then that's not going to be good for the dollar, and it's going to drop it against the Chinese currency. But this is not something that should be too much, in the top of your head, because this is not likely to come into fruition this year. Then you have the corporate tax bill, and this is one of the big things, right? Because what Biden plans to do this year that he's been harping on is increase taxes on corporations, right? So if I'm Apple, he's increasing the taxes, right? Well, what does that mean for me being Apple? If taxes are increasing and my profits aren't really changing, or or my sales aren't really changing, that means I get a smaller net profit, right? Because I have to pay more in taxes. Well, I don't like that. I want to make money. So what are we going to do to combat that? We're going to raise our prices. We want to raise our prices on the phones, on our watches, on our laptops. So if corporate taxes get raised, since they'll be making smaller net profits, all they have left to do is increase their cost of goods and services. And what's the result of that? Increase in inflation, because that's raising the cost of goods and services, which will equal a weaker dollar. Because if we're at 0% interest rates, like I mentioned, they're inverse relationships. If we have a 0% interest rate and an increase in inflation because the prices of goods and services are rising, the dollar's going to drop. So this is something that we're really watching, to where if Biden can get that tax bill changed when he takes over presidency, then we're going to see a drop in the dollar. Now, I did some digging, and I want to put some research on what experts think out there, what they're saying. And, on average, most experts are thinking, well, we'll see most likely a 5-10% dollar decline through 2021. And some are even saying 35% decline. But let me give you a couple examples of the top banks like Citibank. Citibank came out and said they are forecasting a 20% decline next year for the dollar, or this year, 2021. Goldman Sachs came out and said the dollar was 20% overvalued at the peak in March. Now it's still overvalued around 10%. Well, I couldn't find a number from them, but if they think the dollar is still overvalued by 10%, well, I would guess that Goldman Sachs would expect the dollar to drop about 10% this year, no? So Citibank thinks that there's going to be a big decline. Goldman Sachs thinks it's overvalued. Some are saying 35%. So there's a lot of big banks and economists thinking that we're going to drop next year as well. Now, Stephen Roach is a very renowned economist, one of the top economists in the world. He thinks that there's going to be more than a 50% chance the US dollar could collapse by the end of next year. And he says this is based on historical evidence and economic cycles. Peter Schiff expects more dollar decline next year, stating 2021 may be the worst year ever for the US dollar, at least until 2022. So you have Stephen Roach and Peter Schiff, who are two of the top biggest economists, analysts, investors out there. And then you have all these analysts stating that in 2021, the stock market's future looks very, very bright, and risk is on, and they're expecting the market to climb. Well, I'm going to bring this up in a second, but the US dollar and the US stock market have an inverse relationship, because the dollar is a safe haven and the stock market is invested when there's risk on. So if they're inverse relationship and analysts expect a very bright future in 2021 for the market, and economists and banks are saying they're expecting a large decline in the dollar in 2021, well, that's what we're all thinking. That's what we should see, right? So now, technically speaking, what are we looking at? Here's the dollar I pulled off of my chart. This is the chart of the dollar, the monthly chart. And I want to kind of walk through this with you and show you what I'm looking at. So this point right here is the peak of 2008 and 2009, the financial crisis. This move right here was mid 2010 to 2011 peak as well, right? So this is a double top right here, pretty strong level of resistance. Now moving forward, back in 2018, we retested that level and rejected it, right? But what did we do after that rejection? We moved right up to this peak right here, this 104 level, and that's a double top. Because this move right here, this peak was March of this year, when we had that big move up, because that's when COVID was introduced. That's when we had those lockdowns. So people started moving to the dollar for their safe haven. March of this year, or I guess last year in 2020, was when we had produced this double top right here at 104. Now from there, we're starting to move down very sharply down to $90 right here, $88. This is going to be a pretty significant level to break. This is what I call the neckline. If we can break the neckline, we should be poised to start dropping low pretty fast, right? So this level right here, this 83 level, is a 5% decline. And this level right here, this nice level of support is around 79, is that 10% decline. And right here around 74 to 76, this zone right here, this is going to be that 15 to 20% decline, which is what a lot of analysts are looking at, right? Citibank's looking at 20%, which is right down here at the low of 2011. So this is the big, large overview. So what I'm looking at is a break of the neckline, pull back a tiny bit, and then start just moving down towards 15%, maybe around 76 area. So what I want to show you now is a weekly chart of the dollar versus the Dow in 2008, 2009. So looking left over here, this is the Dow Jones. And this big move up here where this yellow line is, that's all of 2009. And this right here before it was 2008. Now, if you take a look right here at the very bottom of that move of 2008, that's March of 2009 right here. That's where we pivoted and started moving up and recovering. Well, if you look right over here at the dollar, this move down, this nice big yellow line, is 2009, the same thing, the recovery of the financial crisis. The Dow was moving up, the dollar's moving down. But if you look again, March 2009, that was the start of the drop of the dollar. Now, that's why I mentioned they have an inverse relationship. Risk on, market pivoted March 2009, started moving up. Risk on, the dollar pivoted March 2009, started dropping, year after the financial crisis. I do also want to mention that, let me get back one slide, that, back in 2008 right here, Yellen was actually the Fed policymaking committee. She was on it during the financial crisis. And now she's the Treasury Secretary. I think that with the dollar knowing her pretty well and what her rap is, back in 2009, we'll probably see the similar move. Now, this was a 15% drop in the dollar back in 2009. That's why us at Vant Trading are expecting a 15% decline, a very similar drop, and that's what we're looking at. So we're looking at the same move down, right around 76 area. So lastly, I want to show you that, this is the US dollar index futures relative to the S&P 500. Now, historically speaking, this is a 20-year range, 20-year average. January and February is when you'll see a rebound in the dollar and a drop in the stock market, which is why March of 2009 was when you saw that rally in the stock market and that drop in the dollar, because January and February are historically a rebound for the dollar. So that's what I'm looking at, is if we can start seeing the dollar hit that neckline and bounce off January and February, then March is where we should see that peak again in the dollar and see it drop. See, this is just drop. And this is the same thing to where you have the S&P 500 dropping in January, February, creating that bottom, and in March start pushing up and creating those highs. That's what I'm looking at, because they're inverse relationships. So, that's another thing that I'd like to mention, is this is a 20-year average of what typically happens, the dollar versus the S&P. Now let's close it out with a summary. What do we talk about this entire presentation? Supply and demand. It all comes down to supply and demand. Stimulus packages. Keep an eye on whether we're going to print again in February. Was this stimulus package December 27th actually a down payment? Will we print more in February? We'll see. Interest rates and inflation rates. Is he going to raise that corporate tax bill or the taxes for corporations? Are the interest rates going to stay at near 0%? If that's the case, weak dollar. Risk appetite. Will risk stay on? Will the vaccine distribution continue to bring light to the economy, continue to bring a positive consumer sentiment? That's what we're looking at with the risk appetite, is the vaccinations. If the vaccine distribution stays on track, starts pushing out even more, if we start getting positive results from the vaccine and the people taking it, that's going to continue increasing our risk appetite, and we'll start seeing the dollar drop even more. International trade uncertainty. Will Biden say anything about reducing the tariffs on China? That's what we're looking at. If Biden holds off on the China trade war and holds off on messing with it, then there won't be anything that'll affect that. Keep an eye on that. And I mentioned the corporate tax bill. Again, same thing. So that's it. That's where we think the dollar is heading in 2021, down 15%, down to 76 area, with all of those factors leading up to supply and demands. If you have any questions on what I went over, any further questions on what I didn't go over, anything at all, please reach out and let us know. Please let us know how we did. Make sure to like and comment on this video. And if you haven't already, please subscribe to our channel and turn those notifications on so you get notified every time we put one of these great videos out. Thanks for tuning in, and I will see you next time.